Well, the financial times, they are tough right now, no doubt about it. But just because they are, does that mean that you don't want to invest? You don't want to look for opportunities? The big question is, how cold is the ice water in your veins? Joining us right now, Steve Sexton from the Sexton Advisory Group to talk about how you approach risk and the perception of risk. How does somebody go about, first off, evaluating how they feel about how much chance they want to take in investing?
Well, I think the big thing here is to understand how people have looked at risk for the last 100 years. They go to an advisor, and the advisor says, are you high risk, moderate risk, are you low risk? The only problem is in 2007 and 8, people lost anywhere from 35 to 60% of their assets being at risk. Now, the big thing is to understand what true risk is and understand one's comfort level.
Now, the basic theory here is that the greater the risk, potentially, the greater the return. But it's all potential here. There's no guarantees.
That's correct, Mark. The big thing here is this. When you look at risk or investing, you look at, we've broken it up into three worlds. The first world is a safety world. That's your CDs, your government bonds, your fixed annuities. We all know, hey, the time's guaranteed. We know the interest rate, and you know what? We know it's all guaranteed. We're probably going to get anywhere from 1% to 4% over the next year.
Which, right now probably isn't looking too bad to some people in the rearview mirror.
Yeah. And then we have the risk world, which is the stocks, bonds, mutual funds. If it's an annuity, it's a variable annuity. And you know what? You can gain or lose 40% here inside of a year. But the big thing to understand is nothing's guaranteed. Your returns are open-ended, meaning you've got to sell in order to get those returns. Next, the market goes up and down, and that means you got to be in there for a little bit of time. Now, the next world is a hybrid world. Now, it takes its guarantees from the safety world because you can't lose anything, and it gets its growth from the indexes. So the first one's a bank product. It's an equity-linked CD. They link the growth instead of to interest rates, but to currency, commodities, the S&P 500. So if over 3 years it goes up, hey, you've made all that money, but if it goes down into the toilet,
you
lost,
there too.
No, you lost nothing.
Oh, okay.
You got to remember,
well now,
it's a CD. It's FDIC insured. Now, the next thing is an equity index annuity. People like these because, say, it went up 10% one year, okay, or this year. You get that 10% and it locks it in. And the next year it goes up 10% further. But when the market goes down, you haven't lost a cent. You only get the gains, you don't get the losses. Now, here's the big thing. The returns there could range anywhere from 0 to 25 in the next year, but the average is about 6 to 10%. Now that somebody knows these three worlds, they can take control by saying, you know what, I only want 20, 30, or 40% at risk. I want 10% in the safety world. And you know what, and the rest I want in that hybrid world. But now they can control it because they created their own priorities, and they say, hey, you investment person, I only want to deal with these things.
But there's probably a certain percentage, and I probably tend to fall into this group, right or wrong, which says, I'm a risk taker. Come on, bring it on, I can handle it. How do I know when I'm stepping out too far? Is there any way to know? You talk about a prudent man rule.
Yes.
Okay, get me in that category.
Okay, well, it's also
risky but prudent.
It's also called the rule of 100. And essentially what you do is you subtract your age from 100. I'm 47, so that leaves 53. It says a prudent person would have about 53% of their assets at risk if they're the age of 47. But when you get into 60 and 70, it should only be about 30% at risk, maybe less. The important thing here is to know how much risk you really need. Now, one of the things that people probably need to do first is understand what type of return they need from their nest egg in order to live the life the way they want. So if they only need 4 or 5%,
it's never going to be enough.
Ever. But for some people it is. But for other people, you know what? Hey, they've got what they need. Why put it at risk?
Okay. So that's you have to know that about yourself, though, and you probably need to sit down with somebody such as yourself and go through this. Then the next thing people are going to ask you is, okay, how do I know which investments are good investments? How do I pick the right either risk or hybrid or low risk investment?
Well, first of all, like I said before, it's important for them to say, hey, look, I only want 20% of my assets at risk. From there, you can start asking questions about the quality of investments there. So, for example, if it's a mutual fund, all mutual funds have fees. They all have certain rankings. So if you go on Morningstar, you could find out you have the number 5 fund of 2,300 funds. Now, you don't want the number 2,300th fund, but you probably want the first 5.
Somebody's investing in those, aren't they? Mm-hmm. Or they wouldn't be there.
That's right. They have really great names, and they seem like they, you know what, I don't want to mention any funds,
sure,
but they have some, you know, beautiful names that people go, oh my God, I got to invest in that. That sounds great. The big thing to look at when you're looking at investments, especially mutual funds, it's all about the management. So if you have a management that does well and has good returns, you're going to see them over a 3, 5, or 10-year period.
So I remember years ago, it was Peter Lynch, wasn't it? That was the guy. That was the fund manager that everybody wanted.
He's the Hall of Fame.
I don't know if that's true anymore, though. I haven't done my homework in a while.
Well, Peter Lynch, he's the godfather of mutual funds, and he probably should belong in the Hall of Fame there because he did very, very well with the Magellan Fund.
Right. And
it is all about good quality management. So, for example, most mutual funds, they don't have the managers having their own money at risk. Only about 7% of all the 14,000 mutual funds, the managers have their own money in the fund. So you want somebody who has skin in the game.
That would be a good thing to know, wouldn't it?
You typically find out they have less expenses, lower returns, and you know what? At the end of the day, they're going to perform far better than the other ones.
All right, a lot of great information, but I know if folks weren't taking notes right there, they're going, oh, I should have had a pencil with me. So you need to go see Steve Sexton at the Sexton Advisory Group and get more information from him. The phone number's right there, 800 number on your screen, sextonadvisorygroup.com as well. It's always great to see you.
Thanks, Mark.
Thank you so much.
Appreciate you having us.
Great information.